All right, welcome back. So today is Saturday, January 14th, 2023, and instead of doing a weekly trade review by looking at the stock charts, I'm actually going to go into a little bit of a lesson today. The lesson that I'm going to go into is when to cut losing trades. This is a big part of trading, and every trader should know when to close out of a losing trade, because if a trader stays in a losing trade for too long, they can end up losing a large percentage of their portfolio, which is never desirable, or at worst, they can have a margin call. What is a margin call? A margin call is when you basically lose everything, and that's something that is very undesirable for everybody. So let's jump into this. When should a trader cut a losing trade? So 1 to 5% of an account is when a trader should cut their trade. Preferably on the 1 or 2% side. And even at that, a trader should aim to have small losses to break even, and at worst, a small loss. A big loss is something that is to be avoided at all costs. So, what does 1 to 5% of an account look like? So, take for example, if you have $100 in your trading account and the trade goes in the opposite direction that you intended it to go in. So let's say you bought a call, you thought that the market would go up, and it turns around and it becomes bearish. If you lose one, if the account goes into the negative of $1 to $5, you should cut that. The reason why many people don't cut their losing trades is because they think it will turn around. They think that the market will turn around, and the market can turn around, and there is a possibility that it probably will turn around, but in doing so, you are facing the potential of having your account in a drawdown or blowing your account and having a margin call. So let's I'll show you a little example of this. So right now we're looking at the S&P 500 for Friday, January 13th. As we can see over here, the market was very, very bullish. The price jumped from $393 to $398. Market open to market close. As we can see over here, the market was bullish in the beginning and then a little bit bearish. So let's say somebody realized that the market was going to go down. They entered into a put over here and they weren't monitoring their trade and thought that the market would turn around as it went up, just in hopes that it would turn around, and hoping that it would turn around, just continued to go up and up and up. Now, I'm not saying that the market can't turn around, because it can, and it does in many cases, but it's usually safer to take a 1 to 5% loss than to hope that it will turn around. It's a better idea to read the market and what the market is telling you than to assume what's going to happen next. So 1 to 5% of an account is when you should usually trade. Now, that's the way that we do it. Traders have their own way of doing it. Other firms, other institutions, other companies have their own way of trading and investing, but this is the way that I like to stick to it, and many other people agree with this methodology as well. So let's move on to our next question. Why should somebody avoid a drawdown? The reason why you should avoid a drawdown is because drawdowns can add up. You don't know exactly how much you're gonna lose. If you buy one contract of something and it goes into the opposite direction, you could be in a drawdown of 10, 20, $30,000, depending on how far you let that go, and then eventually you might just run out of funds and you might have a margin call. So it would be a good idea to cut your losses at a very, very at the beginning to avoid those drawdowns. Now, some people with larger accounts, let's say somebody had $100,000 in their account and they were in a drawdown of $10,000 because they knew that the trade was going to reverse and turn around based off of the support resistance levels, based off of other indicators, based off of other things that the chart was telling them, then that would be okay. However, a 10% drawdown is still pretty big. Most traders and investors stick to 5%. So, with that being said, we are gonna wrap up this lesson by going over the fact that you should cut your losses quickly. The way that your trades, the outcomes of your trades should be either number one, a big loss. A big win. A big win, a small loss, break even. You should avoid large losses at all costs. So a large win would be like this, S&P, getting into this call, staying in it for the rest of the day. That would be a large win. Small loss would be over here. If you entered into a put, closed out, you would have either broke even or you would have lost not too much. You would have made more than you would have lost. And break even, monitor your trades. If you realize that a trade is reversing and that it's turning around, cut it right then and there, so that you're at zero, or how $5, $10, $20, $100, however much you feel comfortable with. So with that being said, I'm gonna wrap up today's lesson. If you have any questions, head over to www.awakeglobalcapital.com. Send us a message, send us an email. We'll respond to you as soon as possible, and looking forward to hearing from you.